Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of the Options Playbook, and I'm going to be your host for about the next 25 minutes here on Options Guide TV. Retail, that is the earnings theme this week, and we looked at 3 trades in Home Depot, and we're going to review those trades. Home Depot is down a little bit today, which is ultimately what we really wanted to happen. And then we're going to look at a new trade in Target. And we also have a pending trade in Zoom that we entered. Zoom's going to be announcing this week too, along with the slew of retail earnings. And we bought a long call in Zoom a little bit ago. Zoom hasn't done much and the trade hasn't done much, but I just kind of want to prepare ourselves for that trade. If you do have it on, we might leg into a long call spread. And that was the theme to start with. I'd like to buy, if you have a company that you kind of like fundamentally, along with maybe technical, I sometimes would like to buy a call option a couple of weeks out as you head into earnings. And if the implied volatility goes up along with the stock, well, then you sell the call option. If it doesn't, well, we know implied volatility is probably going to go up. So then we sell an option against it. And we roll into or adjust into, not really rolling, adjust into a bull call spread and ride it through the earnings report. And that's what our outlook was on Zoom, and we're going to look at that. Then we have our Home Depot trade, and we ended up kind of just going on a tangent, having some fun on Friday. And we looked at a skip strike butterfly, but it was really tight butterfly. But the fact that it was really tight allows us to do quite a few legs on that trade. So we looked at a couple of day butterfly that expires this Friday. And then we had compared it to a butterfly that expires next Friday. And then lastly, we decided, well, maybe we'll do a skip strike butterfly. And that will be the third trade that we look at. Now, Home Depot is announcing earnings tomorrow on the open. So we could adjust the trade. You could put the on today if you wanted to. But as always, I always want to emphasize, I don't have any idea what your portfolio is and your risk tolerance. So make sure that you trade accordingly. It's not necessarily meant to be a recommendation for just your account. So I always got to throw that out there. With that said, we have Target announcing on Wednesday before the open. And Target actually showed up on Earnings Whispers as one of the more volatile stocks this week. They're showing a 10% implied move, which is a fairly big move for a retail underlying stock. So we're going to do one on Target. Let me see exactly. It said that around earnings, the average move is around 12%, which that kind of surprised me. I didn't know that Target moved that much around earnings, because you look at Home Depot, you look at Lowe's, you look at anything in the retail space, it's a lot of times around 5 to 6%. And we're seeing a 12% average move in Target and 10% implied move. So what I'm going to stick with the bearish theme on this. And it's mainly because, well, Walmart came out and had actually a poor earnings report for Walmart, but the stock hung in there. Stock was up heading in, well, I guess after the earnings report, after the poor report, after the actual conference call, it was, I guess, perceived as good what was said in the conference call, even though they were saying that they're anticipating that prices are going to go up and how they're going to manage that and all the deals that are involved, and the fact that they're worried about it, but they're saying they will manage it. So I kind of think more of the same is going to happen with a lot of the retail stocks. Now, I don't know if they'll be able to pull it off like Walmart does, like Walmart did this earnings report, but I want to continue to stay bearish on these retailers. Okay, so let's run to the Tradier Pro software, and we're going to start in the first butterfly that we introduced, and I'm going to send this to the ticket here. We did this trade, and I'm a little bit confused on why this trade is down. Actually, 240 is where it's trading. Actually, I think it's maybe about the same. I think when we were on the show, we might have quote unquote got a bad paper trade fill, because Home Depot is at this point in time down today. Well, the whole market is struggling, right? That's for the Zoom trade. Let's put Home Depot up here. So right now, the fact that the debt of the United States was downgraded has driven the markets lower and brought up fears of recession once again. And so because of that, we're seeing the SPX down 1/3 of 1% at 59.39. And Home Depot is down also about that amount, about $1.30. So either the stock might have ran up a little bit heading into the weekend after we let's see exactly where we closed at. See if we got a green candle there. And by the way, Alibaba is announcing on Wednesday before they open also. Okay, so yeah, we did have a green candle. So we might have closed up at the end of the day. And so now we've just kind of given back what we closed up at. So I'm frozen. There we go. Okay. So 248. So here's the trade. So it's basic. We're about flat on the trade that so far. Market's at 379.49. The butterfly that we wanted to look at is an open wing butterfly. We're buying the 377.50 strike put, at the same time selling the 367.50 strike put and buying the 362.50 strike put. So this is 15 points wide, and looking at the bottom at your screen, and this is 10 points wide, and this is 5 points wide. So we paid about $2.50 for the trade, and right now that's where it's at, $2.50. And if we look at the what if calculator, then we run into the trade. It's an open wing in that we opened up this wing, and if the market does come down and it blows through our strikes, we're profitable. If we paid $2.40 for it, which is what price it grabbed, then that would mean we could make $2.60 on the trade. Bottom line is that if it goes below this strike, if it goes below the 362.50 strike, at that point in time, this thing should trade for $5, which is the difference between the spreads. The long put spread is 10 points. The short put spread is 5 points. And 10 minus 5 is 5, meaning that if the market goes down this direction, you make 10 on this one, you lose 5 on this one. Net, you're up 5 on the position. Now, ideally, you would like it to just drift down a little bit and close somewhere within this range right here. And then you're up more than 5 on the trade. So you have the potential to make a little more. If it goes all the way down, you approximately doubled your money. And then if it goes on up, you're risking $2.50. Now, we looked at a different butterfly too. We went out an extra week, and we're going to keep all of these on file. And that trade is actually, well, based off of where we traded it at, we're up a little bit based off of the screen grab that I took on during the show. I think we did this for close to almost the same price. I remember when we were talking about it on the show, we'll say it is the same price, like $2.50 for it. And so right now it's trading for this. We got to send it to ticket. There we go. Yeah, gosh, the market just must have moved just now. Once again, it seems to happen when we do the show. We're going to move up a little bit, but it's 224. And once again, I was kind of surprised how much less this was trading for than the shorter term one. But 226 is where it's at. So I think we're actually down about a dime on that trade. Here's 523.1. We did it. We did it for 240. So we're down 20 cents on the trade. We were able to get the midpoint price of the paper trade was the midpoint price of $2.40. So we're actually down 20 cents on this trade. If you put it on today, that means you would have a benefit of being up 20 cents. 379 396, we did the same strikes and we just went out one extra week to the expiration date. If we won't go back to the what if calculator and we look at it, looks very similar, right? Same type of trade, same type of graph. Now, lastly, and this is a trade I think we kind of wanted to focus on. We put it out to the crowd and got a couple of comments on it. But the skip strike butterfly, which is only 2.5 points wide, and it's the only thing I didn't like about it, because that's what we had to do to get it done for a net credit to the account. But 397.50, we're gonna need to clear this out. 397.50. We did this for 25 cents. And if you did a few of them, and I kind of like normally I'd like to do the things wider and then say we're only going to do one contract on the show. Oh, that's a sell. And this is right around that nice round 400 number, which that's where we would like it to stop if it made that move to the upside. And then we're going to buy this one. So we did this for a well, there it is. It's right where it's at. 22-cent net credit. 25 cents is what we got on the show, and we're trading right there. So it's like nothing ever happened almost. The only one trade that is down a little bit is the May 30th butterfly, open wing butterfly, and that's down about a dime based off of where we grabbed the screenshot from. So with this said, this trade looks interesting. If you're doing more than one lot here, I'll send it to the what if calculator and we'll look at the risk. Now there's more risk in this trade on a risk reward basis, but there's more likelihood of success on this trade because we just need the market to be below 400 would be ideal. If it could stay below 400, we're going to be profitable on the trade. But here's where the stock is. It's at 380. 400 is our middle strike. We have a few days remaining to the expiration date, and that was another thing that kind of worried me a little bit more on the Home Depot trade. We always like to do skip strike butterflies on companies that like to announce earnings on a Thursday, and then you got 1 day for the option contracts to live. All the volatility, all the time premium has to come out. And if it does drift up towards your strike price, well, you have a potential that it could land within the strikes after that earnings report. We're always about the expected move out or a little bit further between the expected move and one standard deviation to the upside. And that's where we're at. But right now, if you put the trade on with vols where it's at, this is the profit and loss graph. Once again, an alternative to selling a short call spread is what we're looking at here, where we're bringing in a net credit to the account. When we're doing this around earnings, we get enough vol premium that we're actually taking that credit and paying for a butterfly. And that's the way I like to explain the skip strike butterflies, in that if you were thinking about doing a short spread to try to capture some of the vol premium, this is a interesting alternative, especially on the shorter term expirations, because if it takes a few days to get up to this strike, well, ultimately the fact that you were wrong about your forecast and the market actually went up, right? You could actually be rewarded. You could put it on for a net credit and take it off for a net credit on both sides. 22 cents was a good trade. This is a solid trade at this point in time. They announce on Wednesday, so you got all day Wednesday. They announce on Tuesday. They got all day Tuesday, all day Wednesday, all day Thursday, all day Friday. 5 days worth of time decay. Implied volatility is going to come off after that earnings event. But if you did this a few times, if you did this, each one of these is going to have a $500 or a $250 requirement. We went 2.5. Yeah, make sure I did that right. Yep. So the requirement is 250, and very easy to figure that out actually by going down and looking at what is your max loss on the trade. So they're saying that we're filling this at about 20 cents, and you got to look over here to see it. And what that max loss is your requirement on the trade. It all depends on where you're getting the fill at, but the way to calculate the skip strike butterfly, if you want to calculate it manually, it's inside the options playbook, optionsplaybook.com. We give you the formula for calculating it. But this spread is 2.5 points wide. This spread is 5 points wide. It's the exact opposite of why the open wing works on the other side, in that if we're looking at this trade, the maximum you can lose on the short spread would be $5. But if that happens, you're going to make $2.50 on the long spread. So subtract the two out, you're going to have a margin requirement of $2.50 on the trade, minus the net credit received, because you can use that as your margin requirement. And you come up with, if you see it, if I put my cursor down here, $231.50, which is basically saying that they're thinking we're going to get about 20 cents when that trade got placed into the actual profit and loss calculator. All right. Any comments or questions on that trade? No, I don't see any. So here, let's move on. Let's look at Zoom, because that's another trade that we had on in the account. I think I put that in the what if calculator. So on Zoom, with this trade, we're about flat on this trade too, even though Zoom actually is up a little bit. Zoom, it's about $5.65. We can go back to the, yep, $5.65 on Zoom. And our goal here, Zoom is going to be announcing on Thursday, Wednesday after the close. Wednesday after the close, they're announcing. So market, we paid about $5.50 for it. I think we're up about 15 cents on the trade. If we're going to roll into a bull call spread and we have this position on, we got the 80 call on, we're trading for 565. We did the May 30th expiration, gave ourselves a little bit more time. That's right. So here's where our trade is at. It's at 83. So if we want to roll, and we can do this Wednesday because we'll have an options guide TV. If the market continued on up and I could make even $1.50 or $2, I'm going to get out of the trade and just take the risk off. And that's why we bought the long call, because when you buy the long call ahead of earnings, you're thinking that implied volatility is going to increase. You're not worried about the volatility crunch if you get out before earnings, right? So you're trying to take advantage, trying to get implied volatility and the movement of implied volatility on your side. So we haven't had that strong move to the upside. We're pretty much flat on the position, which is fine. And so now we'll go out and try to sell something against that position. We'll probably look at selling something around a 20 delta. If you know, it's all depending on what you want to risk on the trade, but that's going to put you right at about the expected move. It's going to be close. 380 plus 4. Let's see where the expected move is at. Let's clear this out and let's just buy the long straddle. Oops. $7. So on Zoom, we're 722. 7.22 divided by 83. Yeah, that's not going to be tough. You're looking at about 8.5% move to the upside. And that puts you right at about 90 right here. So I don't mind selling any of these calls. It's relative to the premium that you that you really want to pull in. Do you want to pull a little bit more premium in, give yourself a little bit less upside? That's fine. Or you go out and sell somewhere next to the 92 level. And that would be the trade. That will be the trade. We'll look at that trade on Wednesday. Now let's look at Target. Does anybody have the Zoom position on that we put on? Not that long ago. Just tossing it out there. If you want to share, feel free. Target 98.23. Implied volatility is 76%. Earnings are Wednesday before the close. That's why we have to talk about it today. A lot of times you might adjust your trade and do it tomorrow. Do it the day of earnings, closer to the close, if you want to just make it 100% an earnings play. But if we look at, we got $100 stock and we can lean bearish, we'll look at both of the trades again, see if we can pull off. We got 1 point strike, so we can probably pull off the skip strike butterfly at a decent amount. But let's look at the open wing butterfly on the downside to start. So the stock's at 98.26. Let's buy the 27 right here. We're going to get this done fairly good, I would imagine, considering vol is at 76%. Let's do the May. Let's do the 23rd. Let's do the 23rd. And I kind of like this better. So you got all day Wednesday, all day Thursday, all day Friday. So you got 3 full days of trading after that earnings announcement. 95, buy this one. 97, we're going to sell this one twice. And let's do 6. Then it would be a nice flat number. Yeah, I don't mind that. So now we're going 6 points, and then we'll go 3. 88, buy. Try it again. Buy. 6 points. Sell. 3 points. Buy. All right. Yeah, 156. That's not too shabby. And that's because it does trade at a higher vol than Home Depot does, and the overall cost of the underlying stock. So we're going to send that to the what if calculator. 1 by 2 by 1 for $1.56. And once again, we got about a 50-50 scenario in that. If put it at 154 here. Okay, so if the market goes down, we did it 6 points wide, and we have a 3 point wide scenario. Well, I'm sorry. The long put spread is 6. The short put spread is 3. We're going to pay about $1.50. Our other trade, we paid about $2.50 on Home Depot, and the difference between the spreads was 5. So Home Depot's a little bit more pricey stock, and because of that, in Home Depot and Target, we're going to do it a little bit tighter on Target. It's still on a percentage basis, kind of representing a close to the same move. And then we got a 50-50 trade. If the market blows through our strikes, we're going to pay $1.50 to try to make 3. If it finishes right in the middle, the maximum that this thing could trade for would be $6 minus that $1.50 shows you that we're making about $4.50 over here. Once again, you got to focus your eyes right up here when you do this on this profit and loss calculator. Now we're a little bit off. I'm going to say that we filled it for, let's make it simple. Let's go 155, and that will be our paper trade for this one. All right, and then let's go look at a skip strike. Do the same thing. We'll learn a lot about these today. Okay, now this one might be more enticing. Let's see. On $100 stock, it's a third of the price of Home Depot. 2 points wide. Can we get 3 points? All right, I'm going to look at a 3 point wide one. Let's see. 107. We're going to sell the 110 twice. Then we'd skip the 113 and we would buy the 116. 15-cent net credit. Dang, that's close. I'd like to get a quarter on it. So if we're doing it to try as an alternative to a short call spread, I think you'd like to get a little bit more. You're going to have $3 of risk on this trade, and you're going to be making only about, well, maybe we get 15 cents. Fighting for it. Yeah, I think we got to adjust it to 2 points, which makes me sad. But I think we do. So let's bring this strike up to the 108. And then bring this strike down to the 14. Yeah, we got to, wasn't it 30 cents? It didn't change it much. 1 by 2, 2 and 4. Send it to the what if calculator. I think we're going to go down to the 107, do 107, 109. Let's clear it out. 107. I'd really like to get 25, 30 cents on it if we could. We'll buy this one, 107, sell 2 of the 109s, skip the 111 and buy the 113s. Yeah, we're 20 cents. All right, that'll be the paper trade. That's tight. And if we go through, we'll look at it. Let me grab this one for sure, right where we're at. 120. We're going to say it's 20-cent net credit. And that's what I'd want to fill it at. So we have the open wing butterfly on the downside on target. If you're interested in that, if you're a little bit more bearish on it, or if you want something that's a little bit higher chance of profitability, we're going to look at the skip strike butterfly as an alternative to selling a short call spread outright. So the alternative would be that you wipe out the butterfly part of this, right? And you get rid of the 107 strike and the 109 strike. And you would just be selling. This would mean that you'd have the same amount of risk as far as the margin is concerned. You'd be 2 points wide. But yeah, you're bringing in, wow, the butterfly is only 5 cents. Huh. So you're selling the credit spread for 26 cents and you're buying the butterfly for about 6 cents. So if we wipe this leg out, we get rid of the 13 and you just do a 2 point. I think it's just because it's so tight. So you buy this and sell 2 of these, and this one becomes a buy. Yeah, it's saying 8 cents. So 26 cents minus 8 cents means 18-cent net credit. Does that make sense? We're selling that credit spread to pay for a butterfly. So the butterfly is extremely cheap because we're on a $100 stock and we're only going 2 points wide. Really wanted to go 3 points, but couldn't quite get there. So this is the trade that we're going to look at. It's going to be the skip strike butterfly. And I'll grab it from the what if calculator one last time and we'll throw it in there and we'll call it a day. If you have any questions, please let me know inside that chat box. I'm happy to try to address them. Now is the time to put them in there. Net credit is 16 at this point in time. I would put it in at 20 cents. I don't want to do it for any less than 20 cents. Then you got a $2 requirement and you can make up about 10% of that $2 requirement, which is 20 cents on the trade. And then you'd have to do a few of them, right? And the market is great if it stays anywhere below 108. If it drifts up and lands at 110, you're wonderful. You start getting nervous at about 112, and then the max risk all the way up at 114. So you're talking about you need to go more than a standard deviation move, not quite 2 standard deviation moves. what did we say? It was $7. Is that what we? No, it was a 10% was the expected move, because we grabbed it off of there. So the expected move was about 10%. So you're talking about $10. So from 98, a 2 standard deviation move would be about once it was a 10% standard deviation move. Is that right? Let's go back and look at this. Yeah, $10. So we're talking about 1 standard deviation move being about 110, about right here. For it to go all the way up, you're going about a standard deviation move and a half, right? So here's 116 actually, is right about 112. And then you're going all the way up to 114. So basically the expected move, 1.5 of the expected move. 1.5 times. And that's what it would take. That's what it would take to get all the way up to this level, to where you could lose your max risk on the trade. All right. Well, that's going to be it for this edition of Options Guy TV. Thanks for tuning in, and we'll be back on Wednesday and see how all of these trades play out. I think I like the Home Depot one the best. I am going to put that trade on, I think, in my account, heading into the earnings at the end of the day. If I can get it done for a net credit of about 25 cents, that's what I'm going to work for. The skip strike butterfly using calls out of the money on Home Depot before they announce earnings tomorrow. Thanks for stopping in. Please check all of the speakers out inside the Tradier Hub at hub.tradier.com, and we'll see you this Wednesday for the next edition of Options Guide TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.